Hi, this is Aaron Young, CEO of Laughlin Associates and best-selling author of the book, The Corporation Manual. A lot of folks will come and talk to me when I'm out on the road speaking, and they'll say, okay, I know I want to start a business. I know I want to get incorporated, but I know there are a bunch of different options. Which one is right for me? And while there is really no one-size-fits-all, it really does require some conversation where we make sure that we really tune in very, very finely on what you're doing. There are some generalities that we can cover that will help you get a pretty good sense of the direction you're probably going to go. So what I'd like to do right now is cover the three most common business entities, what's really good about them, and maybe some of the things that may or may not be right for you. So let's just get started. The first entity is called a C corporation. All corporations start out as a C, a common corporation. C corporation is what you see with almost all publicly traded companies. They have tremendous flexibility about who can own shares in that company. You can be an individual, you can be another corporation, you can be a fund, a foundation. It could be any number of possibilities for owning shares, but it's the most flexible of all the different entities. You'll see that C corporations can have their own fiscal year end. In other words, they can choose their birthday. Other structures go from a calendar year, January through December, but a C corporation can decide when it wants to have a fiscal year. This can be very useful when you have multiple corporations or entities that are moving money between themselves, making loans, doing projects with each other. It's useful to have different tax year ends. So that could be useful for you with a C corporation. Also, C corporations can have multiple classes of stock. That's great if you're going to be raising outside money. So you could have a seed round, an A, B, C round of stock, and all of those different rounds have different rules associated with what does it mean to me as a shareholder in the B round of this fundraising. So that's kind of a cool thing. You can set up employee stock option programs. You can do, well, there's just a ton of interesting things you can do with a C corporation. The main thing is if you're looking at going public, or you're looking at being acquired by a public company, or you're seeking some other reason for going after outside investment capital, C corporation is very likely the right entity for you. Now, there are 5.91 million corporations or LLCs in the United States of America that have 10 or less employees and either one or two owners. And in those situations, almost invariably, they don't need all of the flexibility or all of the reporting and hassle of a C Corp. They decide to have a simplified election and they become an S corporation. S corporation is really a terrific entity for a closely held company. It doesn't have to be a small company, but it's closely held, one or two owners. A lot of times those owners are going to be spouses or relatives or good friends who want to kind of lock arms and work together to build this company. These are the mom and pop businesses that are out there. They file as an S corporation. They're on a calendar year. The great thing is any gains or losses that come from that corporation are just going to flow up to their Schedule C and be filed with their regular tax return. So there's only one tax return to do instead of two or more, depending on how complex your life is, with a C corporation. S corporations are limited in who can own the shares. First of all, only a human being can own the shares of an S corporation, and that human being has to be a U.S. citizen. So if you have an aunt and uncle up in Canada or over in France that want to invest money in your business, they're not going to be able to do that. It's got to be a human being and a U.S. citizen to own the shares of an S corporation, and you can have up to 100 shareholders. Most of the time, it's going to be one or two people. Now, the other entity that is super popular, as a matter of fact, it's the most popular entity that at least we're forming at our company right now for business owners, is the Limited Liability Company, the LLC. LLCs are kind of new, whereas corporations have been around for over 500 years, and there's very good case law established around corporations. LLCs are new. They started in 1974 in Wyoming. It took until well into the 1990s before all 50 states adopted LLC legislation. And there's still quite a lot of ambiguity about how to deal with LLCs from state to state. But here's the cool thing. If you and some friends are coming together to start a new business, and maybe one person has some investment capital, another person has a database, somebody has some technology or other intellectual property that they've created, and then maybe somebody else is just going to put in the hard work of going out and selling the products and services. And you all come together. In an LLC, you can decide who's going to own how much. How are we going to divide up the gains and losses? How is that stuff going to flow out? How are we going to do distributions to different people? You have complete flexibility in an LLC to work with a small, highly engaged group of members, of owners. Also, in an LLC, it was designed so you never end up with some partner, some new owner that you don't want. Most LLCs, unless they write something different in their operating agreement, if a member dies or leaves, the LLC is disbanded if the other members don't have somebody they want to bring in that other member's place. So what ends up happening is you have tremendous protection of your dream, of your vision, and of your team. The other thing that's really cool about limited liability companies is they have something called charging order protection. And without going into too much detail, what that means is if there is a lawsuit and if a member of the LLC loses that lawsuit, then their judgment creditor, who now has some claim on the assets of that individual, they can't come and take away the membership from that member of the LLC. The most they can do is step up in front of that individual and take any distributions that might be coming from the LLC. However, the LLC can make the choice of if it wants to make distributions or not. And even if there is no cash distribution made, there's still going to be a K-1, kind of like a 1099, that's issued to the members. So what that means is that judgment creditor could theoretically end up with a tax bill for money that they never received. Do you understand the implications of that? That makes LLCs a very undesirable target for lawsuits. It makes members of LLCs undesirable for frivolous lawsuits because the person who might win that lawsuit may never get what they're seeking and may end up having to pay taxes because they threw themselves into the middle of that little hornet's nest. The big thing for you to remember when you're making a choice about what business structure is right, whether it's a C corporation or an S corporation or a limited liability company, is how is this thing going to protect me? Why do I want to go to the effort of setting up a business entity around me instead of being a sole proprietor? Well, the reason is that business entity gives you like a fortress wall around you and around your business that you're building, and it keeps your stuff and your business stuff separate. So when you look at the different entities, you have to say, for my particular situation with this particular ownership, with these particular business goals, with this exit in mind, what entity is going to be the right thing for me? Am I starting off with the right thing? Am I following all the rules to make sure that I get both the lawsuit protection and the tax benefits that I'm hoping for? And how do I stop problems before they ever even start? Just like an LLC can be a good dissuader for a commission-based lawyer to take on a case because they know that they don't want to win against an LLC and maybe end up with a tax bill but no money. The same thing applies with all these different entities. You want to be looking at what's right for you and how is it going to stop problems before they start, and how is it going to give me the most direct path, the smoothest route to get to the end game that I'm hoping for. Now, some of this can be confusing, and we don't expect you to have all the answers right away. As a matter of fact, one of the worst things that you can do is make a rash decision about which business entity is going to be right for you. And a lot of times you're going to have well-meaning friends, family members, or just something you've heard maybe on the radio or you've found on Google that's going to make you inclined to go a certain way, but that's not necessarily the right way to do it. People have been having questions about this stuff at least since we've been in business, since 1972. And you should feel comfortable to know that at Laughlin Associates, consulting is always free. You can call and talk to one of our business consultants. They can answer all your questions. There's no requirement to buy anything. You know, a lot of times we'll have people that are 5, 8, 10 years calling us, downloading stuff, getting free white papers and ebooks, asking questions of the consultants. They never buy anything. Our goal is that when you're ready to make the leap, when the time is right for you, we hope that we'll have earned enough trust that you'll at least come to us to see if we're the right solution for you and for your business.